Look at this chart. That tiny blip at the bottom is what Wall Street expected from Intel on the night of April 23, 2026, about 1 penny per share. And that massive spike shooting off the scale, that is the 29 cents they actually reported, beating expectations by 2,800%. They cleared revenue forecasts by over $1 billion, and in after-hours trading, the stock instantly jumped 20%. To understand how wild that is, we have to rewind to 2024. Apple had already abandoned Intel chips for its Mac lineup. The company entirely missed the Nvidia GPU boom, and in a single year, their stock plummeted 60%. Silicon Valley had quietly written them off. Yet somehow, in just 24 months, a legacy tech giant engineered a 150% stock recovery and posted one of the most surprising quarters in its history. Here is how they pulled it off. The turnaround begins with a new CEO. In March 2024, Lip Bouton took over with a very specific mandate: ruthlessly cut layers of middle management and fix the core manufacturing business. The priority was Intel's most advanced chip process, known as 18A. Within a year, it entered high-volume production, with the manufacturing yield, the percentage of chips that come off the line working correctly, improving by 7% every single month. Management was so confident in these operational improvements that in April 2026, they bought back their manufacturing fab in Leixlip, Ireland, for $14.2 billion. Paying a premium to buy back an asset you previously sold cheap is a massive financial bet on your own trajectory. These aggressive internal cuts stopped the company from bleeding out. But internal efficiency alone wasn't enough. Intel still lacked the massive capital required to survive a global hardware transition alone. At the exact same time, the US government was staring down a severe national security risk. The American economy was entirely reliant on advanced chips manufactured overseas, primarily in Taiwan. This chart illustrates the White House's solution. Under the finalized CHIPS Act terms in August 2025, the government stepped in as a financial backstop. They negotiated an $8.9 billion stake in Intel, specifically priced at a floor of $20.47 a share. With the stock trading around $78 tonight, the government is looking at a return roughly 3.8 times what it paid. Washington's money bought Intel the political runway it desperately needed to keep operating, but federal funding doesn't create consumer demand. The actual revenue explosion came from a sudden shift in software technology. The first wave of the AI boom was all about training. Building giant foundation models required immense processing power, and that hardware market belonged exclusively to Nvidia GPUs. But the market has moved into phase 2, inference. This is the act of actually running those trained models at scale, answering user queries, running background agents, and executing real-world tasks. Inference requires a totally different hardware architecture. Instead of the massive, concentrated bursts of power needed for training, inference puts a heavy, constant load on data center CPUs. Intel already manufactures the vast majority of the world's server CPUs. Almost overnight, their existing hardware went from a stagnant commodity back to a critical, load-bearing pillar of the modern data center. The market got its clearest proof of this on Wednesday. Elon Musk announced that Tesla, xAI, and SpaceX plan to use Intel's upcoming 14A manufacturing process at the new Terafab complex in Texas. That is the complete picture. Leaner internal management, a massive financial floor from the US government, and the explosion of AI inference demand all collided perfectly in the first quarter of 2026. The global AI hardware race has split into two lanes. TSMC builds the GPU brain that trains the model. Intel builds the CPU spine that runs it. Right now, both components are completely sold out, and both manufacturers are scrambling to build more capacity. At $78 a share, Intel trades at 100 times forward earnings, assuming absolute perfection. To justify this, first, 18A yields must improve. Second, Musk's promise becomes a funded contract. Third, CPU demand remains a sustained trend, not a one-time restock. 2 years ago, investing heavily in Intel was a highly unpopular multi-billion-dollar national security gamble aimed at forcing domestic manufacturing back to life. Against all conventional wisdom, that federal bet aligned precisely with the next evolution of AI software. The global infrastructure demands completely shifted, the domestic manufacturing was ready, and Intel is officially back in the race.
This is Market Truths. Clear analysis of markets, technology, and power.